Welcome again, everyone. This is our webinar, Where Do You Invest $10,000 Today? We have three great and extremely experienced speakers for you today. So we have Swapnil Mishra, who is our head of private wealth here at Crystal AI. We have Meichl, who is our head of advisory. And we have Asheesh Chanda, who is our founder and CEO here at Crystal AI. So across the three of them, these gentlemen have got decades of experience in the banking industry. So coming from various banks and functions. So I would say this is your chance to ask any questions that come to your mind. So this is the most important thing I'd like to tell you. So on Zoom, you will find the Q&A tool. It should be either towards the bottom or towards the top of your screen. So there you will see a small Q&A icon where you can ask us questions anytime. So please send us your question. We have prepared like a couple of minutes of introduction, and then we are happy to take all of your questions and answer them. If you have any other questions, if there are any other questions that we don't get to answer in this webinar, please send them to support@crystal.ai. And we will come back to you shortly. And one more important thing, this webinar is being recorded. Of course, we are not going to share any personal details, but just for your information. Okay, so I think with this, we can jump right in with the question, if you're starting out today as an investor and you had $10,000 to invest freely, where do you invest them today?
Thanks, Barbara. In terms of, firstly, I think if you have $10,000 to invest in the current market condition, I think that's a good problem and a good question to have, given the current circumstances, which is tough for a lot of people. And then everyone is trying to figure out how things are going to be. So in terms of where you want to invest the $10,000, before jumping into where the money should be allocated, and I know we are all excited to find out where to put the money, I think it's important to just spend a minute to understand that as an investor, it's very important to have some kind of a plan. I mean, even if you're making a holiday plan and you're going to a destination and you land there, you need to make a plan that are you going to go there and rent a car, or are you going to take a driver who's going to help you, see the place around. So some kind of planning is needed, just to be clear as to what are your requirements, what do you want to achieve out of the investment exercise. And sometimes in our rush to find the right destination for investments, we don't spend time in this entire exercise of planning on the goals and what you want to achieve for that investment. So first is understanding whether you want to do it yourself or you want to use experts to help you in that process. Second is what kind of volatility you're comfortable with. So, if you're sitting in a car, are you okay with a 60 kilometers per hour speed, or you want to go a little faster, or you are like really, you're the Ferrari kind of a guy who wants to drive at 120 kilometers per hour. So understand the volatility and the risk that is comfortable to you as an investor, because there is no right or wrong answer. It's a personal preference. Some people like it in a certain way depending on their situation. The third thing is the time horizon. Whether you're looking at for 1 to 2 years or 2 to 5 years. And of course, the longer the time horizon that you have, the more flexibility you have in terms of investments. Now, I know these questions are, they've been around for many years and they are used for risk profiling. But I feel that these questions have been undermined because in many cases, you do this exercise of profiling and then you end up, recommending the same product. So in a way, this profiling has been undermined. But I do feel it's a very important aspect before jumping into, where you want to invest the $10,000 in the current environment.
So let's assume I have $10,000 that I don't need for the next 3 years. Does it make sense to invest the whole of the $10,000 now? Or would you say I should wait until things settle down before I invest?
Yeah, so good. So since now you've established that this is something which you have the liquidity for, let's say 3 years, and you're looking to invest it, However, in the current market condition, and these are extremely special circumstances. I mean, they are being compared to situations like, you know, how in the World War II the governments were handling the crisis, and this is being compared to those kind of situations. So really, these are tough times. Now, the thing is, in any decision that you make, you end up being caught in some kind of a trap. If I buy and the market goes down, then I'm going to be really disappointed. If I don't buy and the market goes up, then I'll be disappointed because I missed the opportunity to actually invest in the markets. And so, you know, if it was matters of love, you could use just a rose and go, I know she loves me not, which is fairly, you know, scientifically proven. But in an investment scenario, it's slightly more difficult. Luckily, we have people like Thomas in the team, our head of advisory, and extremely seasoned and experienced in this area. So I would love to, you know, pass this question on to Thomas. Thomas, how would you resolve this dilemma of investing $10,000? Sorry.
Yeah, thanks very much, Swapnil. That's indeed, I think, timing is one of the most difficult questions when it comes to investing. And as you rightly said it, I think the biggest problem is regret. Yeah. So what we want to do when it comes to timing, you have the human factor of psychology and emotion comes into place, because people tend to have regret. Oh, I should have bought here, I should have sold there. And let's be honest, I think there is nobody in this market who is always getting it 100% right. And we also have to be agnostic to that nobody's perfect on picking the exact bottom. As nice as it is when you tell your friends, yes, I bought that stock at the absolute low level, or that ETF sold it at the absolute high level. The timing is the most difficult part when it comes to investments. And I think the other problem is always that it's something, and Swapnil, you mentioned this quite correctly, is the timing. I would pin it to assess in what situation are we right now. What is the level of uncertainty, and how are we able to predict the future in the near term? And I have to say, I've been in this business, in this industry for 25 over years, but it has never been so difficult to predict what's the world going to be like in the next 3 months, because we don't know right now. Yeah, there's so many unknown unknowns, as we say, that make it very hard to make a sensible prediction where the market's going to be in the next 3 months. So you have a very wide distribution of probabilities here and very different scenarios. So in a scenario where you have this very wide distribution of possible outcomes, the best thing that you can have, the best approach that you can take is to space it out over time, to use an average cost approach, or to use a systemic investment plan, where over a certain time frame that you as investor, you should also be able to determine this for yourself. Did you say, well, I have this $10,000, when do I want to be invested? Yeah, pinning it into the current scenario. I don't know when we will reach the peak in terms of like the coronavirus story narrative, but I would say if I had $10,000 now, by summer, by August, I would like to be invested probably. So I would space my investment out over the next 3 to 4 months until I reach this 100% investment path. But that's also different from each individual. So if you have $10,000 now, and that's kind of like 100% of your investable amount, then don't be I would say too aggressive on the timelines as well. Whereas if you know this is 10,000 and in 6 months time or in a year's time there will be another 10,000 which you have accumulated from saving, you can be a little bit more aggressive, and there's a bit more flexibility on this one. Yeah. So that's one approach. The other approach, what I often see, and this kind of like makes me smile a little bit when I saw various reports from analysts over the last couple of weeks, where people said, oh yeah, after every correction, when the market corrected 20%, within 6 months we rallied back and the market performed back. Please be careful with that as well, because this is something you only notice with hindsight bias. I saw the first comments and the first reports that came out, whether it was from analysts from reputable banks or newspaper articles that came out when S&P was still at 3,000, and we had already the first 15% correction. Now we are significantly lower. Yes, we do rally back. I 100% agree that, but we will only know with hindsight where that bottom was and what was that defining moment that gave us this bottom. So I hope that answers the question a little bit, and yeah, hand it back to you, Swapnil.
Thank you. Thanks so much. But we have parallel. I think the questions can be sent to Barbara as well. So if you have questions, please, and I guess Barbara, if you're already seeing some questions, please feel free to post them to the panel.
Okay. So the next question I would like to ask the panel is, what do you see? Which are the most common mistakes that investors make when they start out? What should I absolutely avoid doing?
Sorry,
Sorry. What are the most common mistakes that investors make in the beginning?
I don't know, Swapnil, you wanna start with that? You have a few more years.
Can I actually take that, because
okay,
I'd like to share a story. So when I started investing, and this is like an honest, I just want to share this kind of and accept the mistake I made. So actually, I thought that I am more like a trader, and I should directly go into trading and not into investing. So investing to me came 1 year after I had started trading. Fortunately for me, I had started trading, and when I say trading, I actually thought that I wanted opinions on a single stock, a single currency, on oil or gold or silver and things like that, on pounds and euros and yen and all those kind of things. And I actually started with a small size of, I think, $10,000, which went up to 12,000 within 2 weeks with the power of leverage and all that. And I thought that I am one of the best traders that has been born on earth. And so I topped it up with, I think, another 40,000. And it's just so happened this was late 2007. So by the time the crisis hit, that $52,000 was back to like 20 grand. And I'd lost like 30,000 just doing things in a gut feel based trading, getting emotions into the ecosystem, trying to be more like a trader rather than an investor, doing a transaction and looking at it every other day that, oh, did it make money this morning or not? Checking the bank account or broker account every few minutes. First days, then hours, then minutes, then seconds, till I realize that I'm going to go, crazy. And then it also starts, if you take a lot of leverage and start doing more very trading kind of trading, it starts having an emotional impact. So I learned the lesson from the market that actually trading is not the right thing. It's investing, and you need to have a horizon. You need to have a discipline. So if there's one message I'd like to give to everyone is that you need to decide on a goal or horizon. If it's 1 day, fine, take it 1 day, but then your size for a 1 day trade should be such that if it's like a lottery ticket. If it goes a waste, it goes a waste. But if you're investing for 5 years, 10 years, that's when you know that, okay, I need to have an asset allocation approach, have a discipline, and then follow that discipline. So have a rule, have an algo, whatever you want to call it. Have a rule, follow the rule, implement the rule. Thinking that every individual can beat the market is something that the big gurus who handle billions of dollars have not managed to do. So there's no way trying to be the next biggest winner, because guess what, the market is king. Market can prove you wrong, and can be even swinging on either side of the pendulum, being very right or very wrong. But market can afford to do that and make sure that you become insolvent or your account becomes insolvent while the market does whatever irrational thing that it does. So the biggest mistake that most starting investors do, if you look at Robinhood's numbers, most people, millennials, went and bought Snapchat. Now, was Snapchat the only stock that would have been the best investment? Probably not. Maybe Microsoft was better, maybe Apple was better, or maybe the Nasdaq ETF was better. So having a diversified portfolio, having some kind of discipline, taking the emotions out, following a rule, These are the things that need to be done. It sounds very boring, doesn't make a good conversation over a beer, but that's the best way to make money over decades. I mean, that's my take, which I wanted to share, and it's a personal experience I had 15 years ago, or whatever, 13 years ago. So I thought I'll share that. But Swapnil, over to you if you want to just add anything here.
No, that's good. I mean, firstly, such kind of confessions, then, I'm sure everyone over here, and including our listeners, are also they have these kind of moments where emotion has influenced, and unfortunately it is emotional. I mean, it's money that you're talking about, so it's not easy to make a decision, and hence what I'll just pick on that one word that Asheesh kind of mentioned, is that to deal with emotion, you need to put rules into place, because they help you form that habit, they help you form that discipline. So in the morning, if I have to go for a run and I'm feeling very tired and lethargic, then the only way to get out of that whole problem is to say, you know what, I have set a rule and I'm going to follow this rule. So the rule becomes the imaginary kind of element that controls the decision making and allows that that calmness to extend to the investment process. Having said that, there are some investors who may be comfortable with a very ride of buying something and investing 10,000 in something, and it goes down to 2,000 and then it bounces back up. They may be comfortable with that. But if you're talking about wealth creation over a period of time on a sustained basis, then you need to have some rules which guide your investment decisions, and which is what around things like planning and goal setting exercise as well.
Thanks for that. So there's another question, asking about the Boglehead portfolio and the REITs. So maybe I'll ask Thomas to take this up. But just for benefit of everyone else, there is a Boglehead 3-fund portfolio, which is named after Jack Bogle, who's no more in this world. He's the founder of Vanguard. So basically, that portfolio broadly invests roughly 40% in domestic bond ETFs. So let's say the ABF bond ETF in Singapore. Another 40% in the local equity market, so let's say the STI, and about 20%, I'm giving rough approximate things, and about 20% in international equities. So it's like a 60-40 portfolio, 60 equities and 40 bonds, and the 60 split as 40 plus 20. So there's some other questions here, is that given that the yield on STI is low, so is it recommended, or does it make sense to replace that with a Singapore REIT? So in this case, the Lion REIT, which is a Singapore specific REIT, because that is likely to have a higher return. So Thomas, would you like to just take a shot at that?
Yeah, sure. So Singapore REITs, or REITs in general, not only Singapore, they have been extremely under pressure over the last couple of weeks, and that has a multitude of reasons. So there's market expectations about retail malls, for example, or mall REITs with the reduced foot traffic and the reduced income from rents, etc., from retailers coming into trouble. There are some liquidity issues for US REITs in the mortgage-backed securities space, which have all spilled over into the REIT sector and have created a very high on paper valuation, I would say right now, for many of these REITs. Now, as I said earlier, I have, or not many of us know how the world is going to look like in 3 to 6 months' time. I would only caution that dividend yields, when we look at this right now, these are historic, most of them are historic dividend yields. Also, a lot of analysts have not really been able to adjust forward-looking dividend expectations for equities as well as for REITs in an adequate manner. I would expect that generally dividends will come under pressure in 2020, 2021. They will go lower. But assuming that all parts are equal, given that we have in REITs seen percentage-wise equal sell-off as we have seen in STI, on a comparative basis, we are trading almost 2 standard deviations over the historic parts in terms of the relative cheapness of REITs versus STI. So from a diversification perspective and with a long-term perspective in mind, I would say this is definitely something to consider. I do not think that REITs are going to go away. This will remain an asset class that is going to have its attractiveness in the long run. And therefore, at the moment, we are at valuations that are similar to 2008 post the crisis. Actually, the 2008 peak that we have seen in terms of price to book value and historic dividend yield has been even a little bit more extreme than what it is right now. But that's hard to say whether there's more background. But valuation has come down. I would definitely say, to sum it up, it is an alternative.
Yeah.
Now, as to
I'll actually, Thomas, I want to add, if I were to just keep it simple and marry this with what I was saying about the rule. See, today, if let's say the Bogle portfolio talks about, Bogle portfolio says 40-40-20, and you do want exposure to REITs, then and REITs is kind of a mixed asset class, which is a hybrid of equities and bonds, because it has an income dividend and it has an equity component. So so what I would suggest is then you can deviate from a 40-40-20 to make a 30-30-20-20, for example, and then say, okay, this is the allocation I will follow. Maybe run some analysis, some backtest on it, and then follow it for the next 3, 5, 7 years. So I wouldn't recommend trading in and out of a line REIT and into STI every other day, because then you'll just miss out on the returns that particular asset class is supposed to deliver, because you'll never get the timing right, and you get too emotional to basically get this thing done. So yes, we are in unprecedented times, but there is a lot of stimulus coming for REITs. I would say that if you need to redefine a rule, redefine it, get the flexibility, but then whatever is a redefined rule, stick to that. So instead of going with a 40-40-20, make a 30-30-20-20 if that helps. Now, that's the thing I would just summarize. So Thomas, so I think another question, maybe Swapnil, you can take that, because there are 2 questions asking about ETFs. So I'll just read that out. So one is that, is your preference to buy ETFs or index funds or individual stocks? And other one is that if I have 10K to invest for 10 years, what are my options? And can I look at US dollar ETFs or US listed ETFs? So we can combine these into one, I think. Yeah. So Swapnil, do you want to take that?
Yeah. So I'll start. I'll say, investing in stocks is always tempting. It's also because we tend to pick stocks on the basis of familiarity. And I saw this, I learned this lesson in 2008, where a lot of investors were buying stocks because they were familiar with those names. So there isn't any understanding of the financials or the impact or what kind of earnings expectations are there, but it's more that, okay, it's a name that I understand, it's a name that I know. So sometimes the decision is influenced by that. I would say in an environment like this today, where pretty much everything is on sale, and hence the need to pick a particular stock which may outperform others. So let's say you pick a stock which gives you 30% performance and the other index gives you 25% performance. Do we really need to take the risk of a single stock pick for the sake of achieving some outperformance because the view on that stock has been right? I think risk reward is in the direction where you are getting reasonably and generously rewarded for taking the risk of buying a basket of stocks. And you can buy that basket at extremely low cost, which is your ETFs. And the dilemma there is then which ETFs to pick. But as a vehicle for participation or routes to market, I think ETF provides a very good, cost-effective, diversified, and in the current environment, very effective tool. For the second part of the question, I think, Thomas, what are the options within the ETF if one is taking that investment, 10,000 allocating across various ETFs?
Well, that is a little bit of a more difficult question to answer, because I think it depends really on the individual risk appetite as well that investors have and the time horizon. So
let's take growth. So for the sake of, let's assume it's a growth portfolio, and I know you. Let's run the algo, but
yeah, I would have said exactly. Let's run the algo. No, but in a growth portfolio, look, a couple of things here. Definitely on the broad asset allocation right now, favorable to what we see on average from the algo at the moment is coming in at about for a growth portfolio 50 to 60% in equities. at that point in time, given where valuations are. And then about 35 to 40% in fixed income. And then there's another part of that is allocation to gold or commodities, which in that current environment is, I treat gold a little bit, and we also have one question that I see in the queue here, which is asking about gold, and I can elaborate in that question here on this part as well.
Yeah.
I see gold as a very important insurance in any long-term oriented investment portfolio. And reason being is that we are at a very important crossroads in terms of record economic stimulus, monetary stimulus, and we have reached the zero boundary of interest rates. So we are really in uncharted territory. We do not know yet what does unlimited QE at zero interest rate mean in terms of future inflation expectations. And therefore, this asset class is also something that gets picked by our algorithm regularly with, I would say, a 10% allocation at the moment. Personally, that's what I feel is even slightly higher, probably 10 to 15%. We've been saying this for about half a year, that investors should consider increasing that allocation, especially if they have a long-term view. When it comes to specific sectors, I go back to gold later, the difference between physical and paper. But when we talk about specific sectors, I think it is pretty clear that we are going to go in, that we are heading towards a recession right now, given the very sharp and abrupt stop in growth that is happening. So it's difficult to say what is the right sector to take here, but take sectors or select sectors that are less prone to swings in cyclical growth. For example, consumer ETFs or consumer goods that we have, for example, there's an XLP ETF and others that are more focused on products of daily needs, where companies have pricing power, which will remain robust in an environment where global recession is going to come. Going back into more detail on gold. So the question was about what's the view on gold versus physical gold, or gold ETF versus physical gold. And here, I want to make one important comment as well. Yes, gold has suffered a lot due to forced selling. That was a lot of forced unwinds that have led to a performance that was correlated with equities and with fixed income. And this is something that we see in every crisis situation. Yeah, the moment a crisis hits and there's an extreme event, the correlations between the asset classes, they tend to go to positive. That means everything sells off at the same time, because people are heavily leveraged, for example, on the equity portfolios. They need to sell assets where they are still in the money to monetize them and to meet margin calls that they might have somewhere else. So that was one of the reasons why gold has been selling off. Now, gold ETF as well, most of the gold ETFs that we have, so for example, the BlackRock Gold or State Street Gold ETF, they are actually trusts. So they have physical gold in London vaults. So you do have, as an investor, unless you think that the world is coming to an end and they can't get the gold out of the vault to liquidate it, there is actually physical gold as an underlying. Yeah. The difference that a lot of retail investors see compared to the gold prices that you get in the shops which are selling gold coins, like a Maple Leaf or Philharmonic gold coins, etc., is that often they get charged as a premium because investors want to hold the physical gold at home. And there's one dislocation that is happening right now. The paper gold that you see on the screen in an exchange price, that is actually the gold price for 400 troy ounce gold bar delivery in the London vault, yeah, of the London Exchange. So there is a physical underlying to that. The problem is at the moment with the shutdown from COVID is a very specific situation that we have not experienced unless in war times there was a similar disruption, that the big smelters which are producing those coins, they are in Switzerland, and they are they have a lot of northern labor from northern Italy, so they can't cross the border at the moment. And there is this shortage at the moment that's happening. So that's why you see the price for a maple leaf, for all these gold coins, shooting up, because they can't produce them to meet the physical demand for that. So that's the dislocation that we have at the moment here. That's a little of an interesting sighting, but in the long run, there is no dislocation. It is self-correcting, and I do think that it will come back. So with a gold ETF, you still have that reasonable set off from that perspective.
Thanks. I think that gold bit information, I think I'll tell my wife, and she'll clearly be very happy with the whole physical gold aspect.
There is a gold vault at the airport here at Chanda.
Yeah.
In fact, I think it was set up, I think, after the financial crisis, because
that's right. Yeah. There's one other question I see in the queue about silver. Maybe I can also take this just in 2 minutes. So gold and silver. Silver has also been very under pressure, and silver is a more speculative instrument as gold, but silver is always like the little cousin of gold. And I've been looking at that gold-silver ratio as well extensively. I do believe that it is a mean reverting relationship, so they move in lockstep, and we have reached last week an all-time high of that gold to silver ratio. So if you look at the price of gold expressed in silver, so you need to buy 115, I think, is currently the ratio. The high was 120 ounces of silver to buy 1 ounce of gold, and this has over 100 years has not moved wider than that. So we are at this all-time high. So yes, for long term, definitely silver is a viable option. But again, it's about diversification. So from a diversification perspective, yes, but it's not a short-term trade, I would say, to go in there. But at these levels, it does make sense from a diversification perspective.
Yeah. I think we have one question on investment grade bonds as well, that we're seeing higher yields. Basically, there's been a sell-off.
Yep.
And the question is is it because the ratings don't hold, or is it because of mandatory encashing? And I think I'll take part of the answer over here because what I'm seeing in private banks, so a lot of my ex-colleagues in private banks are seeing a situation where a lot of these bond portfolios or bond baskets or fixed maturity basket portfolios or funds were there. And because of the very high degree of leverage, and especially in the last, I would say 6 to 9 months, where there has been this hunt for yield, because yields were getting squeezed and there was a motivation to say, okay, let's borrow. Banks were, banks were basically encouraging, to borrow, to buy these investment grade bonds. And it seemed almost like a risk-free trade. And we are seeing an element of unwind over there. So I would say, to your question, mandatory encashing is something which is happening because there are margin calls. Things have slowed down, both in terms of margin call and also because Fed has stepped in. And I think that's where it is. Thomas, you want to add anything, or we can?
Yeah. So no, I want to add to that. My response would have been a bit of both. Yeah, to your point. So I think, honestly, I think with the mandatory encashing is a little bit alleviated with the Fed measures of providing or buying corporate bonds. That has taken off a lot of that pressure. But let's not forget, we are going into this sharp slowdown at a record level of corporate leverage. So there is definitely you see already a number of downgrades that have happened. And therefore, next time, this time of the year, next year, we will see fewer names being investment grades than they are now. I think that is a fact. That is a reality that we have to be, as an investor, cognizant about, and that we have to be mindful about. So we have seen downgrades for Mexico, for example. We have seen downgrades for various corporates. What has been put on negative watch. A couple of these names that move into this fallen angel territory now. So fallen angels are former investment grade bonds that are now high yield bonds. That will happen. Yeah? So there's enormous pressure on corporates which have gone at a very high leverage level into this crisis. and we will see more downgrades of that one. But I put it in a relative context. So we were looking at this the other day. You can extract what is an implicit default rate based on where bonds are trading right now. It's not a straightforward calculation, but we've come to the market has been pricing last week 17% default rate over the next 5 years, which has been higher than what it has been in 2008. So it has been at very extreme levels. But having said that, we corrected also substantially away from these levels. So now it's come more like 9 to 10%, which I think is a conservative but realistic approach, and there will be a lot of downgrades. Yeah.
If we can just go through the Q&A, we have.
Barbara, which ones would you like to pick next?
We have one question about Singapore savings bonds. Are they a good low risk option given the current environment?
Yeah, I think Thomas, maybe you want to talk about the ABF, the bond, the government bond ETF here, or how?
Yes, we have the government bond ETF, but the Singapore savings bonds is also issued by the government of Singapore. Look, I think government of Singapore is definitely obviously a great alternative as a store of value. Yeah? But generally, with fixed income bonds, and again, this brings me back to the earlier answer, is what represents a store of value and what is kind of like the inflation. Now, Singapore inflation is going to be, has been always in excess of what the government bonds have been paying in the last couple of years. So any investor who it's a good place to hide, I would say, but it's not something and it's a good place to maintain your value and store your value, but it's not something to create at these low interest rate levels to create wealth. It's more of a store of wealth rather than a creation of wealth.
Okay. For the next question, I think we need to get our crystal ball out. So based on technical analysis, do you think the market, given like the S&P, has bottomed? Or do you think given the huge stimulus package rolled out by US and many countries?
If I may take that, because I was looking at this morning, yeah, we will know with hindsight. But I mean, to me, the stimulus is unprecedented, no doubt about that. But the way how this walks and talks, this rally that we have seen over the last couple of days, how it walks and talks is a little bit like a bear market rally. So I had the pleasure to be fully involved in 2008 in that sell-off, and I was looking back from the day when the Lehman default was announced. Within 3 weeks, market sold off about 35%. The bounce from that low back to 50% retracement took also another about 3 weeks. Yeah. So right now, the period that we have is sharpest sell-off ever and the sharpest recovery. We're sitting right now at very important previous support levels, and for those of you who are looking at Fibonacci retracements and these technical levels as well, 2,600 in the S&P is a 38% Fibonacci retracement from that sell-off. So it's a very critical mark. Again, I'm not confident to say the market has bottomed until I see a reversal of new infections or lockdowns being eased and the world going back to normal. Given that I don't have the visibility and the confidence to say, yes, we are going back to normal, I'm very hesitant and very cautious of saying that has been the bottom. It might be a double bottom. We might have another chance to go back down there. But yes, definitely, the stimulus has been tremendous. And then also one thing that I would like that makes me a bit cautious as well is when the stimulus was announced initially, or when the Fed cut happened, emergency Fed cut on a Sunday night, the rally we saw a 200-point rally in the S&P that lasted for exactly 2 hours. And then the market reversed it again. So even with a 100 basis point cut, an emergency cut in between meetings, a rally only for 2 hours, that made me very skeptical. Now, I do think whatever happens next, I do think that it will be in a more orderly fashion than the moves that we have seen in the last 3 weeks. And I do hope that we are not going back to that anytime soon. But overall, directionally, again, thinking back of 2008, the low after Lehman was 865 on the 10th of October. Over the following months, we still sold off and we still corrected down, lost another 25% to bottom out at 666 before we could call it a day and before we saw the bottom here.
Okay, so maybe a bit related question is, given the impact on the travel industry, which was obviously hit hard, do you think this is a good time to invest in an aerospace and defense ETF? Like, is this the time to invest in the travel industry?
Well, I don't know about investing. I definitely want to travel. It's not even
It's a very differentiated problem, I would say, because there is, I mean, there's one ETF that is very popular, is the aerospace and defense ETF. Now, that one is not, so when we think about aerospace, it's not only airlines, yeah. So when we look at Boeing, for example, Boeing has a majority of their revenues are also coming from defense contracts. They are playing a very important role for the overall US GDP. So it's a much more differentiated company than just looking at airlines. Would I buy airlines at this point in time itself? I don't know. I personally hate airlines. I think it's the worst business to invest in, because you are flying equipment through the air that's hundreds of millions of dollars worth on a fixed schedule at very high fixed costs, and with ever ongoing price competition. And I do think that the moment that travel restrictions will be lifted, it's going to be again a race to the bottom, because airlines will be fighting to fill up seats as much as they can. So I'm not sure whether there's much pricing power. Their variable cost is good, because with oil at $20, definitely it's cheap for them to fly equipment. But the price pressure is going to remain for a while, I think.
Okay, maybe let's wrap it up with one last question. So what is your future outlook on the oil and energy sector in the US? And do you see any other alternative sectors for investment for a time horizon of 1 to 3 years?
Actually, the oil industry is quite linked to what you just mentioned about the airline or travel industry, because ultimately the entire thing around oil is consumption, and if we don't see consumption levels coming back, so I would say if consumption levels are coming back, then we are going to get back to the same levels of oil price getting supported, because there's a demand, and we'll also have same problems of pollution coming back as well, which right now, it's interestingly, there's one positive outcome that has come out of this entire situation. So I would say as demand picks up, and right now that's something which, as we mentioned earlier, I think Thomas mentioned it, that we're not very clear on whether the lockdown is for 3 months, 6 months, 1 month, what is the timeline and what is the impact. But once demand is back, we will see that we see the consumption supported, and that would influence the price as well as in terms of the sector.
I have actually, there's one last question that I also want to take, and I want to ask that Asheesh. So there's one question, given that you are the experts, and maybe all of us can respond to that in one way or the other. Given that you are the experts, where are you investing your personal wealth?
Okay, so maybe
Asheesh, you want to start with that?
Yeah, I'll give this one. So basically, since the start of this whole virus crisis, And, you know, as we got more signals of the fiscal package and open-ended quantitative easing coming in the US, so personally, I have increased my exposure to investment-grade bonds via the bond ETFs, namely, you know, LQD or VCIT, because I think so my theory is that buy what Papa is buying, and Papa is buying investment-grade bonds. Papa being the US Federal Reserve, right? He has a machine where he can print money and buy bonds. So there is a very high support level on investment-grade bond ETFs that is coming. So that's one. I also see a good amount of value in buying certain equities. So, for example, I do like the technology sector. I actually think companies like you know, the big bellwether names in Nasdaq, the Amazons and Apples and Microsofts of the world, are going to be big winners of this crisis. You know, if you see Zoom's usage has gone up. We're all using Zoom, right? Microsoft Teams is doing very well. Amazon delivery is there all over the place, and similarly, you know, Apple with 100 billion of cash, it's unlikely that they will not be a winner. So they will be able to buy things cheap in whatever industry they want. So actually, I think the technology sector will be a winner. So I have increased my exposure there and in investment grade bonds because the Fed is buying. And as a hedge, I do hold gold and US Treasuries as you know, as part of an allocation. So my whole concept is that if I want to buy more, let's say, technology equities, ETFs, and more of investment grade bonds, I do have to follow a rule and buy certain safer assets like treasuries or gold. So I maintain that balance almost in an all-weather kind of an allocation. So that's what I have been doing. So yes, a little bit of more equities, but slowly, and bonds much more actually than slowly.
Yeah, for my part,
okay,
for my part, I've been buying gold in this environment, and on these tips when we saw the sell-off, and also similar to Asheesh, at the moment, you know, there's this saying, buy when others are fearful, and we have seen a lot of fear. At the moment, I'm still fearful myself, so therefore I'm also taking a very measured approach. But
that's why I'm buying, because you're fearful.
Correct. So, but you know me, Asheesh, I've been fearful for quite a long time. So, so therefore, yes, I have my plan. So I know that we will come out of this. This is kind of like the most difficult situation that all of us have been going through, and also from an economic perspective, it will be a very difficult situation. But I am a very positive person in that sense that I think we will come out of this stronger at the other end eventually, and it will be a big test for corporates. It will be a big test for any portfolio, and I do want to be invested, and I know that I want to be invested by the end of the year, once we have US election also out of the way. So I'm starting my plan now and going slowly but surely, adding every month a little bit to my son's education fund in equities.
In my case, I can see it's completely different from both the answers, because I like to rely on my relationship manager. So Edward is there. And, so I rely on Edward, and Edward uses the algorithm. So I feel very safe with the algorithm and Edward together making a decision in terms of saying what we should be doing. And I really need that, to be honest, because then I can focus on my work, which is to deal with clients and help clients navigate through what they're doing. So my strategy has just been to follow Edward and the algorithm.
I think we can wrap it up here, end it here. Thank you so much, three of you, for taking the time and answering the questions. And also,
does anyone want to ask a question on voice, or is this Q&A the only way, or is there anyone who wants to say anything? Do we try that or no? Sorry,
does anyone, like any one of the attendees, want to talk to us? Want to say anything? If yes, then please raise your hand. But I don't see anyone. Do you see anyone, Asheesh?
No, I don't think anyone has raised the hands, but I'm not sure how this works. So
Yeah, but we are getting some thank yous for the sessions. That's really nice.
okay,
That's
Yeah.
really nice.
that's great.
Thank you.
Thank you.
Okay.
And then also,
Thank
I
you.
think we also said if you have any other questions, please send an email to support@crystal.ai if you can think of
Exactly.
something, and we'll be happy to get back to you on this. Okay.
Thank you,
Perfect.
guys. Barbara just put the email ID also. Thank you, everyone. It's been nice having the session. Hope to get more of you on this in future ones. Yeah.
Thank you.
Thank you.
Thank you.
Thank you.